Don't ignore what the yield curve is telling investors. Oh boy, now Bob wants to go outside. Come on. Can someone remind me how a 14 or 15 pound dog this big has assumed control of my whole house? I don't get it. I don't get it. It's a little dainty. All right, so this is my man Michael Leibowitz, and I'm a big fan of this guy. I like how he writes. He's with, if memory serves us, he's with a real RIA, Real Investment Advice, I think, and I like those guys over there. They got a YouTube channel. Anyway, so right here, the yield curve is a financial foghorn, says Michael. Let's see, right here, his financial foghorn is bellowing right now that something is drastically wrong, as evidenced by earnings growth estimates for 2023. Financial skippers, get it, foghorn, oh, skippers, boats, are going about their business as if no reef lurks ahead and a recession is unlikely. I don't know about that, but I like the metaphors. That's pretty good. So remember, make up your mind, dainty. We've talked about earnings growth. Earnings growth is how stock returns are accounted for. Earnings growth year over year plus dividend yields, all right? It's just that simple, man. So if the financial foghorns are... Jeez, man, look at this guy. Where? Okay, there he is. Can you see him? Oh, now he's on my... There he is. Oh, yes. Everybody loves you. I know. Yes, indeed. Stick to the point, Josh. It's kind of like Rush Limbaugh when the stick to the issues crowd. They used to always crack me up. All right, anyway. So earnings growth, that determines everything. Oh, my goodness. That cracks me up. I'm unsubscribing. I don't want to see your dogs. All right. The yield curve foghorns are often unheeded by investors as they tend to blow well before danger is apparent, leaving many unprepared when problems arrive. I don't know who's not seeing that there's danger out there. Where everyone thinks there's danger, without question. The 10 year to 3 month U.S. Treasury yield curve is at its most negative since 1982. And this is what I had to chuckle at a little bit. Most negative since 1982. Interesting. And so I'm not sure what this is here, but the 10-year, 3-month yield curve. All right, so right here, negative 8.3%. So the 10-year Treasury is almost 100 basis points, or 1 full percentage point lower than the 3-year Treasury bill. That's nuts, dudes. Normally, look at it. The 10-year is 3.5 percentage points, or 350 points above the 3-month bond bill. Excuse me. Look at that. So here we are. The lowest been since 1982. For some reason, it doesn't show us 1982, which is odd. I'm wondering why that is. And I'm not saying he's doing this nefariously. I had to find that a little bit odd here. So where the lowest has been. All right. So anytime we've had the lowest, you can see the yield curve spike back up. And the yield curve is just rewarding. I mean, the longer you loan money out, you want to be rewarded for the risk of loaning money out. So a typical yield curve is if I'm only loaning you money for 3 months, there shouldn't be that whole lot of risk there. I should be able to get my money back in 3 months. And thus, I'm not going to charge you that much of an interest rate because I'm not taking on that much risk. If I loan the money out for 10 years, I'm tying up my money for 10 years. And thus, there's more risk to me. And I will be rewarded with a higher rate of return, i.e. a higher yield. It inherently makes sense, but we're not getting that right now. It's the exact opposite, which doesn't make any sense. The blast of foghorn is deafening, but the financial waters and economic environment appear relatively calm. I don't know about that. Given the strong possibility that history repeats itself and the yield curve corrects, now is the time to examine how and when it will uninvert, go back to normalcy, where the 10-year Treasury is paying 2 to 3% higher than the 3-month Treasury bill. All right, so let's see what they say. And this is my first thing. Since 1986, the 10-year over 3-month yield curve has been a state of inversion less than 5% of the time. So inverted yield curve. We talked about this the latter part of 2019, I think. maybe even the summer of 2019 before something hit in 2020. I'm not going to go into it. But anyway, so right here. So we've only been inverted 5% of the time. But why are we now going back to 1986? I don't like that. We started with 1982. There's the lowest yield inversion since 1982. Why are we going down to 1986? I don't like that. All right, so anyway, what we see here is since 1986, every yield curve inversion has been followed by a recession. All right, so here we go. Yield curve inversions. We had a recession 13 months later. All right, so right here, yield curve inversion, recession 13 months later. Yield curve inversion, recession, I don't know, that's pretty quickly. Yield curve inversion, recession a few months later. 10 months later. Oh, he tells it right there. All right, sweet. Yield curve inversion, recession a year later. Yield curve inversion, recession 3 months later. Yield curve inversion, recession 10 months later. Yield curve inversion, recession 6 months later. And right now we have a yield curve inversion. When's the recession? All right, I want to show something here to you. However, and this is a common theme in the following graphs, economic and financial hardship did not incur until after the yield curve steepened to a positive slope. It's taken anywhere from 13 months to 3 to 13 months to recession to begin. All right, so basically saying that the pain didn't happen until the actual recession happened. So even though the yield curve gave you idea that a recession is coming, you didn't actually feel the full throttle of it until the recession happened. All right. The next graph shows stock market drawdowns following a similar pattern. In all four inversions, the maximum drawdown in the market occurred after the curve started to steepen. All right, this is where we're going to get to some of that challenge. So right here, actually, this is a better one right here. Yeah, right here. This is actually what I wanted to say. Here's a yield market inversion, and there's not much of a drawdown. Here's a yield market yield curve inversion, a pretty significant drawdown right here, negative almost 50% right here. Here's a yield curve inversion, a negative drawdown of 57%. Here's a yield inversion, negative drawdown of 33% in basically 35 days. And here we are now. What's the max drawdown we're going to be? Well, we already kind of got some drawdowns right there. Are we? So this, but here's a yield curve didn't invert. We still had a pretty good drawdown in 1988, and that was in 1987. Do anyone remember that? Of course you do. Anyway, the point being is, let's see if he calls it. Lastly, and not surprisingly, stock earnings tend to fall appreciably after the yield curve troughs and regain its positive slope. So here's the earnings. It's down 32% in 2020. It was down 18% at the end of Q4 2018. Down 92% in 2007, 8, and 9. The earnings. Isn't that crazy? Look at that, man. Down 54% from 2001 and 2, down 36% in 1990, the recession from the Gulf War, and down 10% in 1986. All right, so a couple things I want to point out. We have 4 instances, all right, but now he talks about 4 instances in history, because this is an instance, but we don't know what the future holds with this. So we have 4 instances. But he actually talks about is the lowest curve since 1982. So we have 5 instances. Why are we only showing 4? And we're literally in 40 years, man. Since 1982, we have 5 instances of an inverted yield curve of this significance. Literally inverted yield curve, and 5, and this is the lowest it's been since 1982. What happened after 1982? Anyone want to remember? The markets from 1982 to 1999, I think they averaged like 17% a year, dudes. You had incredible growth in the markets. Don't forget, it's like in 1979, I think, when Business Week said the death of equities. And the market still tossed and turned, and maybe 1980, but for a couple of years after that. But 1982, so the inverted yield curve, the recession already happened in 1980 and 81. All right, 1980, and it also went into 1982, but it happened after the inverted yield curve happened in the same time as the recession did. The recession happened before the yield curve inverted, if that makes sense. It was already going on. Now, part 2 of this, we already had a recession. It was a technical recession. this is the thing. So we've had 5 instances of an inverted yield curve. 4 of them showed a recession later on, but this took 13 months to happen. I mean, I don't know. That seems like, a clock stop and all that. I mean, this happened right away. This took almost a year to happen, and this happened. It wasn't much. But I mean, the point being is it was the COVID stuff. So we have 4 instances. In one of those instances, it didn't happen. The recession happened before the inverted yield curve, or at least during the same time. I don't know if you can make a positive correlation between these two. So we have 2 that are iffy, 1 that didn't happen, and 1 that's pretty obvious right there. On top of that, we've already had a recession, a technical recession. It already happened. Q2 and Q3. The GDP contracted. That's a fact. Now, people say it wasn't a real recession. It is a technical recession. They didn't call it. But this is the wordplay about financial guys. And I'm not saying this guy's doing it, but I'm just like, well, they didn't call it, but it was a technical recession. We just don't have enough data sets to say, because XYZ, this will happen. We just don't. So talking to a guy today, and last year he moved a lot from Contra Fund to Fidelity Balance Fund, which saved his bacon in some regard, but he still got smoked in Balance Fund. Balance Fund's down 16% year to date. The Contra Fund's 26% year to date. But from top to bottom, he's down like 29% or something like that. You know what I'm saying? Because Contra Fund just got smoked. And Balance Fund got smoked relative to whatever it did, but it didn't get smoked nearly as much as Contra Fund. So his question is, should he go less into Contra and more into Balance Fund to take advantage of the more bonds? I'm like, yeah, he's still pretty heavy in Balance Fund. I said, I wouldn't. Because the facts are these guys could be wrong. The financial product, we just don't have enough data sets to say there's a correlation there that would lead to a causation. We just don't. We have 4 data sets, of which we're not using 1982, which is 5 data sets. So we're going to throw that one out, which would disprove the thesis. Of the 4 data sets remaining, 2 are kind of iffy, and 1's what we're in right now. And then the other ones so that could just be complete random noise. Anyway, so I don't know. I see all this. I'm like, I don't know. I mean, I get it. The foghorns are bellowing, but we've literally already had the recession. And so right here, I'm sitting there saying, where's the earnings growth decline? I mean, here we are right now. The inverted yield curve is the worst it's been since 1982. The earnings growth from 1982 on was freaking through the roof, man. And here we are, earnings decline of 4%. I don't know. I mean, anything could happen. You can't, these aren't sacrosanct. I'm not saying this guy's saying. I'm just saying, look, you got a diversified portfolio. You survived through 2022. I don't know why today would be the time. We've already had a recession. I mean, that's the thing, not recession. We've already had a bear market. The max drawdown, right? Look at that. That's what I'm trying to say. This is like 1982 all over again, it seems to me. The max drawdown already happened while the thing was inverted, just like in 1982. So, I mean, who knows? I could be wrong, but just full steam ahead. Hey, look at that. I didn't even plan that. How ironic. All right, love your thoughts. We'll see you.